Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to take your stock-related questions tonight are Grant Nader from Benguela Global Fund Managers and Mark du Toit from Oyster Catcher Investments. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. The markets are really upbeat as the U.S. heads to the polls today. Mark, what is going on?
Well, I mean, I think that, leading up to the election, people have been taking maybe a bit of money off the table, and now they're expecting the result to come through and there'll be certainty again. I mean, either way, we're going to at least know who the president is. And if, typically after the election, if the Republicans get in, the markets tend to have a more favorable reaction. So perhaps people are trying to pre-position for that. But our market was up today mainly because of the PGM miners. So that sector was up quite a bit, which pushed our market up sort of 0.5%.
Well, let's actually talk about the PGM miners and particularly Sibanye Stillwater, because it was up about 10%. I don't know where it actually settled at the end of the session. But just looking at that, Grant, things seem to be going better for Sibanye, of course, except for the PGM prices. But things seem to be looking up. Is that the case? Are we starting to see a turnaround here after a period of really the perfect storm knocking the share down?
Look, I wouldn't say the turnaround is complete, but because they've had a lot to deal with. They've had a significant increase in debt. They've had to restructure. They're shutting down some of their Stillwater in the US production capacity. So they've had, as you said, the perfect storm. They're at least taking action. They've been selling forward some of their production, which is not ideal, but they're doing everything they can to manage the balance sheet, which has been a high risk, to be honest. And I think the reason you're seeing such extreme moves is that the company has become quite highly geared to improvements because there's so much bad news in the price and there's so much risk embedded in the balance sheet, that these positive outcomes. So they had a good operational update. The gold in SA did really well. And I mean, they've been closing some of their mines, but I think at the current price, they can mine the most marginal of production and still make some money out of it. So that's been a positive, and they're seeing the cash flow improve. So I think there's something to take heart from here. Do I think the story has turned completely? I don't. I still think it's a challenging proposition to own this one. But if you've got a bit of a risk appetite, by all means, have a little speculation.
Yeah, I mean, that's the thing, because I get that Sibanye is like a risky stock at this point because of the PGM prices, but also their balance sheet as well. And I'm wondering at this point, when you start to see numbers out like this, where there is an improvement, Mark, is this something where you want to get in now when things are starting to turn around and maybe not at the point where the turnaround is at its completion?
Yeah, I mean, you still need to have a positive view on the PGM metal prices. So, I mean, that is the bulk of their business still. And I mean, we saw a very sharp rally last week, but it seems to have faded quite quickly. So the PGM, I mean, the platinum price is below 1,000 again, palladium below 1,100. So it's really the gold operation that's helping Sibanye out at this point. They would have done even better if they'd had less hedging on, but because they had a weak balance sheet, or they have a weak balance sheet, they have to use quite a bit of hedging just to manage that risk. They're giving away a bit of upside now at this gold price, but I think the market was just maybe expecting a worse number and a bit of a relief rally, and it is quite under-owned because we've seen a lot of buying into Implats, which is the leveraged player with a more healthy balance sheet. And now that it seems like their free cash flow from Sibanye is perhaps not going to be as negative as what was feared, we're seeing the relief rally come through now. But if you want to buy Sibanye, you need to have a long-term positive view on PGM prices.
All right. Well, gents, let's get into some tech. Lots of tech questions today, particularly US tech and also some Chinese. I recently bought some shares in Google, Alphabet. I definitely believe Google isn't expensive and neither is Amazon, but I do believe Apple is. A single-digit growth for Apple, I think 35 times earnings is expensive. Would selling some Apple to buy Google or Amazon be a good move? Or does the panel think I should just hold on to my Apple shares? So Apple versus Alphabet and Amazon here, Grant?
I must say I quite like that trade. I do believe Apple is expensive. I don't think they've grown earnings more than 5% over the past 3 or 4 years. Very slow growth. Highly defensive earnings, of course, and the quality is good, but Google actually has a really attractive positioning in the market. If you consider their hyperscaling sort of endeavors, they're seeing cloud growth, the highest of all of the hyperscalers. Yes, they're smaller, but they're coming on very nicely in that space. They are at the forefront of the AI expansion and offering. The search is being, they're monetizing AI well through the advertising. You're seeing it in YouTube, you're seeing it in search. So I like their positioning. I think they're cheap. Longer term, there may be a risk to that search business, but it's not yet evident from what we've seen in the numbers. And I think you've got a very strong franchise across a multiple pillars. And so I like the business, and I think it is attractive at these valuations.
Mark, would you be leaving Apple for Google or Amazon? And do you think that if you are leaving, then these would be good levels to leave the stock?
Well, I mean, in our funds, we own Google and Microsoft, so those are our preferred in this space. I mean, Apple, you do have to adjust Apple's valuation for the amount of cash that they sit on in the business. So just looking at a pure PE multiples, not exactly the right way to look at it. But I mean, even on our numbers, Apple does look more expensive than Google and Microsoft, which are our preferred players in that sector.
All right. Well, let's go into chips. Is ASML a good buy with the ongoing Chinese and US tensions? Is actually any of that in the price when you look at these chip makers, Grant?
Mm-hmm. So I think it is in the price with ASML. When they reported a couple of weeks back, they've basically right-sized their exposure to China, and that order book's been cut dramatically. China's been close to 50% of their order book for the past 3 quarters, and they're coming in at 20%. And basically, ASML alluded to these trade restrictions are going to keep them at 20%. So I think you have to haircut a good chunk of their earnings over the next couple of years for China. But you also got to look through it and say if that's priced in, this is still a monopoly. They still occupy one of the most critical technology pieces in the entire value chain, and they literally are a monopoly. No one else does what they do. So I still think it's a very good business with a very strong moat. Yes, they're going to lose some sales to China, but I believe that's priced in where we are now. I think the process of they're going to have to earn their way through this cycle. People are going to have to figure out what the impact of China is. And what they also heard by Intel, which is one of their biggest customers, they're struggling. Samsung hasn't rolled out their latest fabs at the same level as TSMC. So I think longer term, they're still incredibly well positioned. I think over the next 6 to 9 months, there's a little bit of churn that's still going to be there. So it depends on your timeline. I think you're okay if you hold it long term.
Well, Grant, optimistic, even with some caution there in some areas. Mark, would you be cautious on this, particularly also looking at the numbers that they produced and the pressure that we saw on the stock after that? Or maybe would this be just a buying opportunity for you for ASML?
Yeah, it's not a stock that I look at closely, but I think it probably is a buying opportunity. The one risk that you do have is that the Chinese are investing heavily in the AI chip making space and into that technology. I mean, they would love to come out with a competitor or competing product. They are worried about being able to longer term have access to these high powered and very fast chips. So there's a lot of investment going into that space. So you are kind of betting against them getting it right. And shares like, I'm thinking now of NVIDIA, I mean, those share prices are really pricing in a rosy future. But in the shorter term, the next three years or so, I mean, until we see some kind of announcement or some kind of real evidence of the Chinese making headway in that space, and these stocks will continue to make a lot of money.
All right. Let's go into beer. And Anheuser-Busch. Is it a buy at these levels? Down 17% this year on a price trading at 1,030 a share. Yeah, they did come out with results. When was it? Last week, and they came out below expectations. Markets weren't even buoyed by the fact that they did announce a share buyback. Grant, what do you make of AB InBev? Would you be finding opportunity at these levels or not?
To be honest, no, it's not one that we like, and we haven't owned it for a couple of years now. We just don't see the quality there. I think they've done poorly with the acquisition of SAB. The return on invested assets is poor. The debt is it's coming down, but they've spent a long time trying to digest that, and they're not seeing growth in the business. So I think it's fairly low quality, and the management hasn't done a good job, and so it's one we would rather stay away from.
Yeah, just that growth picture. What does that look like in your view, Mark?
Yeah, so we actually do like the business. I mean, the investment case is really that they, after all their acquisitions have been or they've completed their big acquisition spree, and now the idea is that they'll make great cash flows and pay down their debt and return money to shareholders, like they've announced the share buyback program. So we do like that. I mean, they did have a big misstep in their Bud Light campaign in the US, which really damaged their market share. And it's been very interesting to see that even a company with a fantastic brand, how much damage you can do to your business if you just have a misstep like that. We tend to think of these global brands as being kind of impenetrable, but if you have the wrong marketing campaign, you can really upset your customers, and it's hard to get them back. And that's really what Anheuser suffered with. The other interesting point about the business is it reports in dollars, but a lot of its earnings are in emerging market currencies. So you've got that currency devaluation versus the dollar often in the numbers, which means that the growth doesn't look spectacular, and which is why they always quote their numbers in constant currency, because they're trying to show that they are growing the business, that the volumes are growing. But when you translate, because of the stronger dollar, the revenue line is not growing as fast as the underlying business. But I think that at the share price now, I think that your future returns will be good from this stock, and it's a big global stock, well diversified, and we think it is one to own for the longer term.
All right. I do love these differing views, by the way. It makes for great TV. Gents, back to tech, but now Chinese tech. Alibaba, there is a question here. Can you give me a view on Alibaba? Is it a buy at this time? Mark?
Yeah, so I guess you're wanting Chinese stimulus to play out. We saw a big rally in the Chinese market a few weeks back, basically before they went into their holiday periods. A lot of buying ahead of that, on the view that a large stimulus package is going to be announced. We are expecting this week, in fact, for them to come, for the Chinese authorities to come to market with a new announcement. And because they're in their economy, they're trying to move away from a construction and a property-led or an infrastructure-led economy to a more consumer-led and a consumer-driven economy. We're expecting that the incentives will be favoring stocks like Alibaba, like Tencent. So yes, we do like those stocks. In our funds, we hold Naspers and Prosus for the Tencent exposure.
All right. Yeah, Grant, do you think that they are, Mark talks about the fact that the stimulus is more to drive consumer demand and, of course, benefiting these consumer stocks like Alibaba and Tencent. Would you have a preference there in that market or not?
Yeah, you know what? I'm a long-suffering Alibaba shareholder. They have been disappointing for a long time, but I think if you look at their cloud positioning, they are still the leading cloud player in the Chinese market. It is a massive untapped market, and the companies are not going to be allowed to utilize the Western hyperscalers. So they are well positioned there, and I think that monetization has been slow in coming, but I think it will come. And then, of course, the AliExpress is growing quite healthily, the international piece of the consumer exposure. And of course, locally, though, they are being outcompeted by Pinduoduo, the owner of Temu. People might know it from that. So there are some challenges there. But as Mark said, if that stimulus comes through, the rising tide lifts all boats. So it's not as cheap as it was. I still think it's cheap enough with enough potential to justify owning it at these levels.
I feel like my brain just switched on because I didn't know that AliExpress is part of Alibaba. I should have known, though. It's all in the name. Let's go into the motor industry. Please, could you help me understand why combined motor holdings have dropped over 15% over the last 3 weeks? Generally thought the comments had been quite positive about the company, and they actually have been, but have things changed because of the macroeconomic landscape, Mark?
I'm not sure that the macroeconomic landscape has changed that materially. I mean, in the motor space, we are expecting a lot of Chinese entrants next year. I think there's 7 new manufacturers planning to enter the SA market, which will be quite something for our small market to handle. So there's a lot of competition coming. However, with interest rates expected to continue to reduce, and we are expecting a better South African GDP outlook, I think that the motor industry will continue to do well. It's just the sales or the market share gains between the different companies are going to look a bit skewed. I mean, I think that consumers are getting a bit more comfortable owning a Chinese car and driving a Chinese car. I mean, in 10 years ago, the Germans' cars is what everybody wanted, but now the Chinese quality has caught up, and we're even seeing brands like the South Korean brands like Hyundai and Kia coming under pressure, just because the capacity that's been built in China allows them to produce at such a lower cost. And when consumers are making that decision, they more and more are choosing the lower cost option in the space.
It's actually quite interesting. I hear your point there on the competition that is coming through for the South African motor sector, but at the same time, I would think that a rising tide lifts all boats. For example, the interest rate cycle that we are seeing now, but with that cooling off in CMH, I don't know about its participation there. Grant?
Look, it's still done okay for the year. It had quite a big run before this pullback. I think they're well positioned. They've got a better portfolio than Motus. They've got quite a lot of Chinese brands on their book. Motus, on the other hand, doesn't. They're only trying to play catch up in that space now. So I think they're well positioned. I think the motor industry has been tough. We haven't seen growth in vehicle sales for a couple of years now. I don't even think we've recovered 2019 levels. So it's a tough space. However, it is a very cyclical space. It is perfectly placed to capture the improvement from a rate cutting cycle, the improvement from an improved growing economy, consumers getting into a better space. So, I think this pullback is a buying opportunity.
All right. Well, gents, let's get into Super Group. Share price has been weak given the poor results. Are you positive for the prospects for the company and worth a buy here? Mark?
Yeah, I think it's a similar type of story. I guess, again, it's a stock that's in the mid-cap sort of space, and he's ran really hard in the first half of the year or post our election and the GNU. So possibly pulling back from their highs. And I mean, in our portfolios, we prefer to look at the larger cap stocks until they've run really to a space where the future returns look way better in the more liquid stocks. So it's, for us, it's not one that we're looking at currently. So I think for us, it's just a wait and see approach for now.
Yeah, there also was a positive sentiment on a Super Group, but of course the numbers they're showing a different side. Your take on Super Group there, Grant?
It's not one that we're too excited about. I think the UK business is really struggling. Their dealerships are not well placed. I think Ford is pulling out of a number of franchises there, and they've got certain issues there. the Australian SG fleet is a decent business, but it has taken on a lot of debt to fund that business. So, I mean, I think they will benefit if the economy improves, but they're probably not your best play if you have a view of an improving SA economy, because they're sort of 2/3 outside of SA in terms of their earnings. So, you know, if you want a pure play SA business to capture that upside, that's probably not the best one.
All right. I was going to run away from Sasol today, but I can't because there are two questions that have come through. The first one is why Sasol has rallied over the last few days. I think I remember when last was on Stock Watch on Thursday, the share was under 100 Rand. It was 98 Rand. I don't think there's been anything really significant. Could it just be investors trying to cash in on that kind of low price where now it's gone up to 104, Mark?
Yes, well, I mean, Sasol is highly geared to the Rand oil price, and we have seen the oil price recover in the last week or so. It is a company that, you know, when you look at the assets it owns, it is cheap, but it has a lot of issues. I mean, we don't know what the carbon tax bill is going to be. There's uncertainty around that. We don't know how much gas they're going to be able to extract from their pipeline to Mozambique. They talk about the gas plateau coming in 2028, possibly now extended to 2030. So it's got a lot of issues. Their business in the US is currently making a very small EBITDA contribution in dollars, and they have a lot of dollar debt to pay down. So in my view, Sasol's a buy when the chemical prices actually go up, because that is the market that they're playing in the US. And if chemical prices turn, that cracker, the Lake Charles cracker, is going to make a lot of dollars, and Sasol's going to be in a very different position. Yeah. But there is a lot of capacity in the chemicals market, and prices have been depressed, and it seems like it's going to be a while before those prices start to go up materially. So we sit on the sidelines for the moment. The stock is cheap, but it's cheap for a reason, in my view.
Is China's stimulus, could it have any kind of impact on Sasol? Because the other question is, should I be buying Sasol with the China MPC meeting this week? And obviously that plays on the stimulus narrative. Grant?
I mean, for my view, that would be too much of a third derivative of the opportunity. So they might stimulate some demand for oil and then increase that, but you've still got the chemical prices to balance out. I think the global growth narrative is more important. Plus, all the overhangs that Mark talked about are massive. They've got serious challenges ahead. I think this is the quintessential value trap, and yeah, I wouldn't be a buyer.
There is a question on why did PEP fall so much today when most retailers are up. Well, I think the last time I checked, all the retailers, or most of them, were down. Mark, any specific reason for this pressure?
Yeah, we were also quite curious as to PEP's price move today. I think it was underperforming by about 2% today. We couldn't find anything specific. So maybe something comes out tomorrow, but I know that, I mean, everyone's expecting more stock to be placed. So perhaps, you know, people are just maybe think it might be coming sooner rather than later, and that could be pre-positioning. Yeah. Also, the MSCI, one of the indices make their announcements tomorrow. I mean, we don't think it impacts PEP, but perhaps it's someone who thinks that there's going to be an index change.
Well, it's all of them. Woolies, Pepco, Pick n Pay, and I think I saw another one earlier, all down more than 2%. Grant, any specific reason? We are running out of time. I'm being chased out.
Ooh, it looks very much like a portfolio trade, you know, basket switching. They could have been buying PGMs and selling retail. Yeah. I don't think it's something substantial underneath the story.
All right, gents, we have 30 seconds or a minute between the two of you for your stock picks. Mark, what are you choosing today?
Yes, so I'm choosing Absa. It's materially underperformed the banking sector. We are expecting a better South African macro environment. Rising tide lifts all boats. We think that we're expecting the second half for the credit loss ratio to be much better than the first half. In the first half, they had quite a few once-off issues like Ghana hyperinflation, sale or write down on their buildings in town. We don't think those repeat. And I mean, this is a stock which is trading on depressed multiples, and I think that their earnings growth is going to surprise a little bit to the upside. And we expect Absa's price recovery to catch up to the other banks. And I think that you will do well to hold the stock with a high dividend yield of 8% and earnings growing above 5% a year.
All right. On your side, your stock pick, Grant?
My stock pick is Prosus. I think you're getting the underlying asset of Tencent at a very attractive price, about 25-30% discount to its global peers. With a strong growth prospect, they're still growing margins. They still have a runway for growth. They are also well positioned in terms of the potential for AI expansion across a number of their business lines. So I think you've got that great core business, and then finally, you're seeing continuous traction in the rest of Prosus. So they are continuing to monetize, turn those cash flows around in all those delivery, classifieds and other online businesses that they have. So I just think it's an incredibly good asset at a really attractive price relative to what else is out there, even just looking at the Mag 7 as an example.
All right. Well, thank you so much for your time and your analysis today, gents. That is all for tonight's Stock Watch. Thanks to our guest, Grant Nader from Benguela Global Fund Managers and Mark du Toit from Oyster Catcher Investments. Up next, The Close. Stay tuned.